Hey guys, global events and economic news plays a crucial role in influencing stock market movements worldwide, and India is no exception. As a rapidly growing economy with a dynamic market, Indian stock exchanges respond sensitively to economic data, policy changes, and global economic trends. Today, our video will show light into the intricate relationship between economic news and stock market movements in India, examining key economic indicators, their effects on investor sentiment, and strategies for navigating these impacts. India's stock markets, represented by indices such as Sensex for the Bombay Stock Exchange and Nifty for the National Stock Exchange, are highly sensitive to economic news. Economic indicators provide insights into the overall health of the economy, influencing investor behavior and market trends. Understanding how different types of economic news affect the stock market can help investors make informed decisions and manage their portfolio more effectively. Economic indicators are statistical metrics that provide insights into the performance and health of an economy. In India, several key indicators have a significant impact on stock market movement. Gross domestic product (GDP). GDP measures the total value of goods and services produced within a country. A higher GDP growth rate indicates a strong and expanding economy, which is generally positive for the stock market. Conversely, a declining GDP can signal economic slowdown, leading to negative market reactions. Inflation rate. Inflation represents the rate at which the general level of prices for goods and services is increasing. The Consumer Price Index (CPI) and Wholesale Price Index (WPI) are commonly used to gauge inflation in India. High inflation can erode purchasing power and lead to higher interest rates, negatively impacting stock prices. Interest rates. The Reserve Bank of India sets key interest rates, including the repo rate and reverse repo rate, which influence borrowing costs and liquidity in the economy. Lower interest rates typically stimulate economic growth and boost stock market performance, while higher rates can have the opposite effect. Industrial Production Index measures the growth rate of the industrial sector, including manufacturing, mining, and electricity generation. A rising IIP indicates strong industrial activity and economic growth, which can positively impact stock markets. Foreign direct investment. FDI reflects the investment made by foreign entities in India's economy. High FDI inflows signify investor confidence and contribute to economic growth, often leading to positive stock market reaction. Trade balance. The trade balance measures the difference between a country's exports and imports. A trade surplus is generally favorable for the economy and the stock market, while a trade deficit can lead to currency depreciation and negative market sentiment. Economic news impact stock market through several channels. Firstly, investor sentiment. Economic news can significantly affect investor sentiment, which in turn influences the stock market prices. Positive news, such as strong GDP growth or lower inflation, can boost investor confidence and lead to higher stock prices. Conversely, negative news, such as rising inflation or a weak GDP report, can lead to market declines. Corporate earnings. Economic indicators impact corporate earnings, which are a key driver of stock prices. For example, higher the industrial production can lead to increased revenues and profits for companies in the manufacturing sector, thus boosting their stock prices. Market expectation. Stock markets often react to economic news based on how it compares to market expectations. If economic data exceeds expectations, it can lead to positive market movement. Similarly, if a data falls short of expectations, it can lead to negative market reactions. Policy responses. Economic news can prompt policy responses from the government and central banks. For example, high inflation may lead the RBI to raise interest rates, which can affect the stock market performance. Similarly, economic stimulus measures can support market growth. To illustrate the impact of economic news on Indian stock markets, let's examine a few case studies. GDP growth announcements. In 2020, India's GDP contracted sharply due to the COVID-19 pandemic, leading to significant decline in stock markets. As the economy began to recover in 2021, positive GDP growth data led to a rebound in stock prices, thus reflecting investor optimism about economic recovery. Inflation trends. In the recent years, rising inflation in India has led to concerns about higher interest rates. For instance, in 2022, increased inflation led to a series of interest rate hikes by the RBI, which impacted stock market performance as investors adjusted their expectations for future economic conditions. Interest rate changes. The RBI's monetary policy decisions can have a substantial impact on stock market. For example, in 2023, the RBI's decision to cut interest rates to stimulate economic growth led to a positive market response as lower borrowing costs were expected to boost corporate profits and economic activity. FDI inflows. High level of FDI can signal confidence in India's economic prospects. In 2021, a surge in FDI inflows into sectors like technology and manufacturing contributed to positive stock market performance as investors anticipated growth in these sectors. Given the significant impact of economic news on stock markets, investors can adopt several strategies to navigate these effects. Firstly, staying informed. Regular monitoring of economic news and indicators to stay informed about factors influencing the stock market. This can help you make timely investment decisions and adjust your portfolio according to the changing economic conditions. Diversify investments. Diversifying your investment portfolio across different asset classes and sectors can help mitigate the impact of economic fluctuations on your overall returns. A well-diversified portfolio can reduce risk and improve long-term performance. Analyzing trends. Use historical data and trends to analyze how similar economic news has impacted stock markets in the past. This can provide insights into potential future movements and help you make more informed investment decisions. Focus on fundamentals. While economic news can cause short-term market volatility, focusing on the fundamentals of individual companies can help you make more stable investment choices. Assess companies' financial health, growth prospects, and competitive positioning. Consider professional advice. Consulting with financial advisors or investment professionals can help provide valuable insights and strategies for navigating the impact of economic news on stock market. They can help you develop a personalized investment plan based on your goals and risk tolerance. Economic news plays a pivotal role in shaping market movements in India. Key indicators such as GDP, inflation, interest rates, industrial production, and FDI have significant effects on investor sentiment, corporate earnings, and market expectations. Understanding these impacts and staying informed about economic developments can help investors navigate market fluctuations and make informed decisions. By adopting strategies such as staying informed, diversifying those investments, analyzing trends, focusing on fundamentals, and seeking professional advice, investors can effectively manage the effects of economic news on their portfolios. As India continues to evolve as a major economic player, the interplay between economic news and stock market movements will remain a critical area of focus for investors and market participants. That's it for today. If you found this video helpful, don't forget to like, share, subscribe to our channel for more insightful content. For more information, visit smifs.com. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.